And risk, I think, is key here because there's so much uncertainty. Stocks are not valued according to future earnings potential, but by sentiment. And as an asset manager, that must be a very, very big challenge.
And I'm really delighted, Rick, that you brought up the word risk, because risk management therefore becomes key. What you want to absolutely avoid are cyclical highs in your performance and cyclical lows. You want to extract something more of a smoother outcome, right? Now, to do that requires risk management. It's much easier said than done, right? The way we do it at First Avenue is we have a portfolio that has three kinds of companies or three cohorts of companies. And these three cohorts, by the way, they seem to contradict each other. And you think to yourself, why would you hold a high quality company? And high quality companies are the bulk of our portfolio. And then you go and hold a turnaround opportunity like Tiger Brands, like Old Mutual, like Pick and Pay, like Sasso. And then you go and hold global cyclical companies that address systematic risk, like gold companies. The three don't talk to each other. Why do you do that, right? And the reason why you do that is because over the long term, right, the more reliable wealth is created by the phenomenon of compounding, which you get out of high quality companies. Those are the Clixes, the Capitec's, the Coulters, the Sanlam, Santums, Outsurance. Those are the bulk of our portfolio, right? And what is compounding? You know, if you put this in layman terms, compounding is really what's called time arbitrage, where we tend to overestimate what happens in the short term, outcomes in the short term. We underestimate outcomes in the long term. So strong quality companies tend to be more valuable the longer you give them, the longer they exist. The structural advantages just build on each other, right? Hence, over 15, 20 years, Clix has generated earnings at a clip that is far greater than the cost of capital. Okay, then you have turnaround opportunities where the value looks very clear. You can see Pick and Pay has fallen badly. You can see where it's trading relative to its net asset value, to its earnings, right? Old Mutual, the same. Now there you say to yourself, now that's a bit harder now. How do I pick companies in that cohort of companies to generate good returns? And you need pattern recognition there. You need to have seen different companies address reinvestment back into the business to pull themselves out of the morass they were in, as Tiger Brands has so brilliantly done. You take a view on that, but that requires a deeper level of experience. And of course, you'll be wrong at different times, more wrong there than be wrong in the compounding cohort, so you cannot hold too many of those. Then the last category, which is really where we are now, is companies that address systematic risk. Gold companies, precious metal companies. There you have to be extremely careful, right? Even within that cohort, you try to find companies that are really well run, the best companies in a bad neighborhood, if one can call it that, the quiet house in a loud neighborhood, if one can call it that. You try to make a distinction between an AngloGold and a Harmony, for instance, from a quality standpoint. You can overweight one and underweight the other one, right? But just make sure that what you miss out on in terms of not being represented in all the companies, you make up for by being represented in one of them, right? So that way, net, you might not do as well as if you overweight the entire sector, but the rate at which the market leaves you behind is minimal.
You've given a very, very high level account of your investment strategy.
Yes.
And I think it comes down to a 10% return in a year can be a better result than a 15% from another investment if it is attained through a lot less risk. Let's put the investor's hat on.
Yes.
If you look at many funds, because there are many funds they can invest in, they can put their money in, how should they evaluate the risk? Not all of them are investment professionals.
Yes.
What do they need to look at
Yes.
to pick the best one?
Yes. So I think this is such an important point because when you look at South Africa, just take unit trusts as an example, right? Whether it's in equity or bond funds or income funds, there are asset managers that have been around for a long time, since 1979, right? And then you have asset managers that have been around for 5, 10 years, 15 years. One of the things that's disappointing in this market is that newcomers have the same product as the old guys. The same product. Product is so commoditized in South Africa that it discourages the investor from going to look at the new guy because they're so comfortable with not only the brand that has been built over 30, 40 years by some of the old managers, but they're also comfortable with the repository of information, which is the brain building to go along with the brand building that's old, right? So investors tend to default to big brands. Now, it's the responsibility of young managers like us to actually differentiate, not just in how we manage portfolios from a risk management standpoint to produce a smoother outcome, but also in terms of the products that we innovate and bring to the market. They have to be so different that the customer is forced to reckon with the outcomes they're getting from a new product or a different product. And old companies, incumbents, have to reckon with the fact that they don't have that product. Now they have to copy you, right? So far in South Africa, new managers don't give the customer the opportunity to explore new strategies, new opportunities by way of product.